Hello, scholars. Welcome to Finance 1100. We are up to Chapter 9. I would like to cover some concepts that you need to know about in order to prepare yourself for the quiz coming up. Okay, so I hope everybody's doing all right. I hope you're managing well. I hope your family is safe. And I hope that your spirits are positive in spite of everything that's going on. All right. So the first thing I want to talk about is healthcare insurance. Healthcare is very, very important. Matter of fact, it was one of the points as far as the political events that took place 4 years ago and that are taking place now. It's always a bone of contention with the candidates of how they're going to improve the healthcare and etc. So why do you think that there's such a concern about the healthcare? What is one of the goals that a politician might have or that the government might have in mind? Well, one of the key goals of the Affordable Health Care Act of 2010 was to reduce the number of uninsured citizens in the country. To reduce the number of uninsured citizens in the country. So that was one of the goals. Now, some people have a job and they work, and part of the job's benefits are that the job covers the employee for health insurance, which is a wonderful thing, and it's very important to attempt to get a job that will at least cover some, or if not all, of the health insurance. But sometimes, especially during this time of COVID, people get laid off. In other words, they then no longer have the job. So what happens in that instance? What happens when someone is working and all of a sudden they are let go or laid off, and now they are responsible for their health insurance? Well, there's something called COBRA, like the snake, COBRA. It stands for something, COBRA. And if you continue to pay this coverage, I believe it's, I want to say it's, last time I looked at it, it was 3 years that you can continue to pay COBRA. We'll have to look that up. So you pay the premium every month, you send it to your former employer, and you will be covered. And you'll be, as long as you continue to pay those premiums, you will be covered just as if you were working. And that's COBRA, but it is you that is paying the bill, not your employer. Nevertheless, because your employer is in a group plan, the premiums are usually much lower than what they'd be for an individual paying for their own plan. So COBRA stands for Consolidated Omnibus Budget Reconciliation Act. Let me type that in the chat box. That's a mouthful. So COBRA, this ability to continue paying for your health insurance if you are laid off, is called COBRA, Consolidated Omnibus Budget Reconciliation Act. Usually the boss, and this is on page 237 in case you're interested in looking that up. As a matter of fact, we're going to look at that. So the boss will give you some kind of paperwork where you have to agree to this COBRA. And then, of course, you will send in the check monthly and on time. So let's see. 237, I'm looking for what it says about COBRA. Let's see if I can find it. Okay. If you're laid off from or leave a job where you have had health benefits, then you are legally eligible to continue your coverage for a period of 18 months or under. So it's 18 months, it's not 3 years, it's not 36 months, it's 18 months, a year and a half. And of course, if you get another job and they cover you, then you won't need the 18 months. But you'll be responsible for paying 102% of the group insurance rate if you decide to continue your coverage during this time. But you'll still pay group insurance rates that are often less expensive than buying individual insurance. However, you must arrange to continue your coverage before leaving your former employer. Importantly, under the ACA, losing your job triggers a qualifying life event, allocating you to obtain health insurance under COBRA, or you can buy a policy in the private health insurance market. But there are critical enrollment windows and policy coverage details to compare. You'll need to do the math and to determine the best option for you. So don't forget, before you leave that job and say goodbye, make sure you sign the paperwork for the COBRA. All right, so we covered that. Now, an individual that receives health care is allowed to receive multiple payments from more than one insurance company for this care. And the rationale is an insured party can collect multiple payments for the same illness or accident unless the health insurance policies include a coordination of benefits provision. So sometimes one insurance company will pay 40%, then the other insurance company will pay another 50%. It won't allow you to double dip or get paid twice, but the more coverage, the less out of your own pocket. Hopefully, you'll only have to take, if anything, maybe a minimum of 10% out of your pocket. I just got off the phone yesterday with something that I was responsible for 10% of the bill, and I was very happy that it was that small because the bill was $160. So that was good. Now, I am over a certain age where my primary health care is now Medicare. Once you kick in as a certain age, once you reach a certain eligible age, you no longer are insured under whatever plan you have. Your primary insurance becomes Social Security's Medicare benefits. So the question is, who's paying these Medicare health insurance premiums? Well, when I was working, Social Security was withheld from my paycheck every week, and that money went into a bucket to pay for the Medicare benefits. So Social Security taxes paid by covered workers and their employers. So employers match whatever taxes the employee pays is matched by the employer. So that's where the money comes for the Medicare. Do not get it confused with Medicaid. Medicaid is different. Medicaid is for low-income individuals or families that have no health care and need to apply for this type of coverage. Medicare is for older American citizens who reach a certain age, and the age is 65. Okay, so again, the rationale is funds for Medicare benefits come from Social Security, also termed FICA, F-I-C-A, another term they use, taxes, paid by covered workers and their employers. You can look at section 9.2 in your chapter under health insurance plans, and you can find out more about this. All right. So there's something called a traditional indemnity. So let me write that in our chat box. There's something called a traditional indemnity. And that is what's called, in parentheses, fee for service plan. The healthcare provider is separate from the insurer. So healthcare providers and the insurer are separate. So that's an important aspect to understand. The healthcare provider, meaning your doctor or wherever you go to, and the insurer, meaning the insurance company, are, and I'll put it in caps, are separate. They are not together, but they work cooperatively together to get your bills paid, but they are not in the same vein. They're separate but working together. All right, so I don't know if anyone's ever heard of an HMO. HMO. So let me type that in the box and let us go to our textbook, and I will read you the definition from the textbook of what it means to be a member of an HMO. What HMO stands for is Health Maintenance Organization. Okay, that's what HMO stands for. And if you look on page 231, you'll see it discussed, and I think 232 and 233. So it's discussed on those 3 pages. So let's turn to those pages, 231, 232, and 233. Let's see what it says about an HMO. All right. I'm just looking here to see if I see where it starts. Okay. These HMOs are called managed care plans. There's also something called a PPO, which is preferred. So a PPO is like a step up. A PPO is a preferred provider organization. For those of you who are accountants, you've heard of common stock versus preferred stock. Preferred stock has certain preferences that people like, and they're willing to pay more for that. And that's the case with the PPO. And then there's also something called an EPO, which is an exclusive provider organization. And finally, there's something called a POS, which is a point of service plan. So these are different plans. They cost different, they offer different services, and so it's up to the person what they feel suits their needs. So let's hear about the HMO. A health maintenance organization. A health maintenance organization is an organization of hospitals, physicians, and other healthcare providers that provides comprehensive healthcare services to its members. HMO members pay a monthly fee that varies according to the number of people in their family. A co-payment typically of $5 to $40 is charged each time services are provided by the HMO or a prescription is filled. The services provide the HMO members, including doctor's office visits, imaging, which is x-rays, MRIs, and laboratory services, preventive care, health screening, hospital and patient care and surgery, maternity care, mental health care, and drug prescription. The advantage of an HMO includes relatively low deductibles, few or no exclusions, and not having to file insurance claims. In the past, the primary disadvantage was that HMO members couldn't always choose their physicians, and they were faced with limitations if they needed care outside their geographic area. So you have to find a doctor that participates in the HMO. That was the disadvantage. Okay, so you could read more about that in your chapter 9. All right, so I have an aunt who lives in New York who is very ill. She has what's called COPD. It's a breathing problem, and she has great difficulty breathing. Just imagine that you go to the mailbox and you barely can make it there because you have trouble breathing. She's that bad. Well, she had a lot of foresight, and she purchased something called long-term care health insurance. Long-term care health insurance. What is this? It's not cheap. I want to say it's probably, in her case, she probably paid $4,000 a year for it. And what it does, this insurance is designed to help with the nursing home, to help with assisted living community, if you're eligible for that, or in-home care due to chronic illness. So my aunt is at home. She has this COPD, which is classified as a chronic illness. And so she is taking advantage of this policy she took out when she was well. And someone comes and takes care of her in her home. The only thing she explained to me when I talked to her this morning, she said she had to wait 90 days before this policy kicks in. But that was her policy. I don't know. Everything varies. So that was her policy. She had to wait 90 days. So prior to the 90 days, she had to pay out of pocket for the nurse or the aide that came to her home. And she definitely needed that person because she needed help. All right. So these are all good questions to keep in mind when you go to buy these things. If I was to go and buy long-term health care, let's pretend I'm 40 years old, and I would ask the insurance agent, so how long do I have to wait before that long-term health care kicks in if I'm ill? Well, miss, you have to wait 90 days. Well, that's too long for me. What happens is there any way I can get that changed to say 10 days, even if I have to pay more on my premiums? So these are the kind of back and forth you want to have with an insurance agent. You want to be what they call an educated consumer when you buy things, whether it be a car, insurance. You want to understand all these aspects. You don't want the salesperson to take you by the hand and maybe not lead you the right direction. So you need to know what you need, and you need to express that and ask for that, whatever salesperson you're dealing with, because otherwise you end up with something you don't need, and you end up with a big bill, which is something that happened to me last week, and I will not talk about it today, but it had to do with my air conditioner unit, and we'll talk about it another day, but I kind of got swept away by the salesman. So I'm just warning you, even someone who knows better can also get swept away. So I like cola. Do you like cola? Do you like to drink Pepsi or Coke? Well, there's something else, C-O-L-A, and we're not talking about soda. Does anybody know what I'm talking about when I say cola? I heard about this term the first time when I worked for a union. Cola is the purchasing power that you have with your income. And this cost, COLA stands for cost of living adjustment provision. So in the contract, when I worked for the union, there was a COLA provision. In other words, every time the year was up, we would get an adjustment in our raise in our salary based on the cost of living. And if my memory serves me, we get an automatic 3.5% increase. And let me tell you, it may not sound like a lot, but it was nice to get that increase. And the next year you would get it again. It was like a guarantee because we were union workers. I worked for a college in New York. So with the COLA provision, it has to be in there, whether it be in a union contract or if it's in a long-term disability policy that you might have. The monthly benefit is adjusted upward each year, often in line with the CPI. Does anybody know what CPI stands for? I'm a CPA, but that's not what it stands for. CPA is Certified Public Accountant. I'm a certified public accountant licensed in New York. So CPI stands for Consumer Price Index. So it's lined up with that. So if that goes up, then the COLA. So the COLA provision is often in line with the CPI, although these annual adjustments are often capped at a given rate. Just as I told you, the given rate for our union, CSEA, is the name of our union, put that in there just so you know, it was 3.5% every year. Okay, so I just mentioned something that you may not have heard of, disability insurance, disability income insurance. What is that? Well, I knew somebody who was a very strong and healthy person, and he worked in a factory where there were latex gloves before they knew any better. And the powder inside these gloves got into his lungs because he worked with them every day. And he was not able to expel that powder in his lungs. And as a result, he ended up with COPD and was had to have oxygen tanks in his house in order to breathe every day. They would deliver these big giant oxygen tanks. Although now my aunt has a portable oxygen thing, so they've kind of come up with different solutions. I don't know if she's got the big ones. I haven't asked her. This is all new for her. So disability income insurance provides income to a disabled or ill person. So, having that in his lungs, the COPD makes you disabled. You're not able to work. And let's see. So the answer is, disability income insurance will provide income to a disabled or ill person with payments made to the recipient up to the age of 70, with a waiting period before income is received. So there's a bit of a waiting period. So I don't have disability insurance anymore because I'm no longer working full-time. But when I had it through the AICPA, which is an organization for CPAs, there was a 13-week waiting period before it would kick in. But fortunately, I never had to use it, but it's very important to have that insurance, because my friend who had that issue with the latex gloves says you have a higher chance of becoming disabled and collecting on disability than you do of running into a health issue. So disability income insurance will provide income to disabled or ill people with the waiting period before the income is received. So basically that's that answer. So dependent children up to a stated maximum age will usually be covered by their parents' health insurance policy. Will usually be covered by their parents' health insurance policy. So what are the details? What's the rationale behind that? The health reform bill, which was, I want to say maybe 8 years ago. Let me see, we just saw it before. The health insurance bill, let me get the right year for you. Of course, now that I'm looking for it, I can't find it. 2010. 2010, so it was actually 10 years ago, time flies. So this bill allowed young adults to remain on their parents' insurance until they turn 26 years old. Until they turn 26 years old. Because why? Some of these dependents were still going to college at that age, were full-time students and hadn't got a job and didn't have their own coverage. So and they were living at home with their parents. All right, so that's the answer is 26, or the stated maximum age of 26. So if somebody's 27, they will not be covered by their parents, even if they live in the parents' home. They'll have to get their own insurance. All right. Okay. The deductible represents the initial amount that's not covered by the policy and thus must be paid by the insured. So I have a deductible of $500 on my collision, on my car. So if somebody dings my door in the parking lot and I go to collect from the insurance company, if that's only $400 to repair, I'm going to be responsible because the deductible will only cover anything over $500. So in that case, but why would I do that? Why would I not make it zero deductible? Because I save some money by having the deductible. And the higher the deductible, the lower the insurance premium. So it made a big difference. 500 deductible probably made a $20 difference a month, and to me that meant something. So I put in the deductible. If I ask for a $5,000 deductible, it's even going to be less. So the rationale is the deductible represents, and I'm going to type in the words so you know how to spell it, deductible, probably know how to spell it already. The deductible represents the initial amount not covered by an insurance policy. And thus, it's the insured's in policy, meaning me. I'm the insured. The insurer is my insurance company, which is, at the time, was Hartford. Hartford was the one. Okay, so we briefly touched on something called a point of sale plan. We briefly touched on a POS, or point of sale plan. Let's see what that is. A POS is a hybrid form of health insurance. A POS is a hybrid form of health maintenance organization, HMO, that allows members to go outside of the HMO network for care. So an HSO is a hybrid of an HMO. I don't know if any of you know about flowers. I love roses. I have some New York roses in my Florida patio. So I don't know if you've heard of a hybrid rose. So sometimes you have a rose that's part yellow and part red. So you've got this hybrid rose that is yellow with edgings of red. That's a hybrid. It's a mixture of the red rose and the yellow rose. It's still a rose, but it's a special rose because it combines two different roses to make a unique and hybrid version. So this, so a point of service plan, and this is all you need to know, is a hybrid form of HMO and allows members to go outside, because some of them have doctors. If you've had a doctor your whole life, you may not want to part with that doctor. So you're willing to pay extra to have that doctor. So a point of service plan, or a POS, is a hybrid form of HMO. All right, very good. All right, moving right along. I'm sorry nobody showed up today, but hopefully you'll get an opportunity to watch this video on my channel with YouTube. Okay. So I mentioned about Medicare And then I briefly talked about Medicaid, which is different from Medicare. And this is a public assistance program that provides health care or health, let's put it be more specific, health insurance benefits only to those unable to pay for health care. So that's Medicaid. Medicaid is a state-run public assistance program providing health insurance benefits only to those who are unable to pay. So keep in mind, every state is different. So Medicaid is state-run. So there's probably different rules in each state. And all right, so we're going to do a little problem here. And it involves monthly disability benefits. So monthly disability benefits equal estimated current monthly take-home pay. Take-home pay is after taxes taken out, less or minus existing monthly benefits. So here we have a scenario. Patrick, his monthly take-home pay is $5,000. His net worth is $125,000, which is probably his house. He estimated he would receive Social Security benefits of $1,000. So he's going to get, he estimated, it's an estimate, Social Security estimated payments, $1,000. He probably called them up and they gave him an estimate. And the company is going to pay disability benefits of $2,000 if he becomes disabled. The additional disability benefit that he needs to arrange for is, we have to calculate an amount. So if you use that equation I gave you, the take-home pay of $5,000, right? And then we subtract in parentheses the disability benefits minus his Social Security, that will equal his additional disability benefit. So if we complete that equation, it's going to be 5,000 minus, I think it's 1,000. Look right? Oh no, excuse me. This is 2,000 plus 1,000. All right. So let's do this again. This was not right. So select. Okay. So let me just bear with me. See if I can copy it. It's 5,000 minus 2,000 plus 1,000. Okay, I had a minus in there. Sorry about that. So plus 1,000, which is equal to 3,000. And that's going to equal total of 2,000 additional disability benefits he needs to apply for. All right, so that's the answer. So let's do our final question, another exercise in computation. So we have a man named Ben. His name is Ben. Let me just see if I have all the information I need. Bear with me. Okay, so Ben is age 40. Ben is age 40. This is a make-believe story. It's a and he pays a low $15 copay. He pays $15 copay to go to the doctor. Each time he visits a doctor. Other than the low per service deductible, there is very little cost sharing. However, Ben has a relatively low deductible, has no exclusion, does not have to file insurance claims. Yeah, that's an important clue. Does not have to file insurance claims. What does he have? Does he have a commercial insurer? Does he have Medicare? Well, Medicare is for somebody 65 and older, so that's out. A fee-for-service indemnity plan. That would be POS, or an HMO. Okay, so it sounds like an HMO. Remember we had that definition of an HMO up here somewhere? Let's see if we can find it. HMO, health organization, health maintenance organization. Let's see. Trying to see if we had our definition of an HMO. All right, well, the answer is an HMO because an HMO, to sum it up, has few or no exclusions, provided we go to the doctor in the network, they call it. No, requires no filing of insurance forms, which people like because nobody likes to file those forms, and low deductibles. So that is the definition of an HMO. So that's the answer. All right, class. Please read the entire chapter. We've touched on the very important high points of healthcare insurance. And now you know if you're under 26, chances are you're under your parents' plan, and you know why now. And you could tell your parents. I'm sure they'd be happy to know you understand that. So please feel free to watch this video again. I'm going to post it in Canvas, and I'm going to post it on my channel, and I will give you the link to the YouTube. Have a wonderful day. Be well, and I'll see you next week.